You know, if you had to boil down the entire financial universe to one single force, it would have to be interest rates. Seriously, think of it like, well, like financial gravity. It's this invisible but incredibly powerful force that pulls on everything: the value of your stocks, the price of your house, even what you pay for your car. And whenever that gravity shifts, even just a little, the whole economic landscape gets reshaped. And that right there brings us to the most important question we're going to tackle. Because every single time the Fed makes a move, it's not some neutral event. Nope. It sends out a powerful ripple that lifts some people up and puts a ton of pressure on others. So the real question is, when that financial tide starts to turn, which side are you going to be on? So, to figure that out, we've got to start with the basics. How does a single decision made by a handful of people in a boardroom actually travel through the whole system and end up affecting all of us? It's all about the journey that money takes. Yeah, it's got a pretty fancy name, the monetary transmission mechanism. That's just the official term for the path from a policy decision to your pocket. But here's the tricky part, the thing that catches everyone out. This process is slow. The effects have these long, variable, and honestly, super uncertain time lags. What that means is the full impact of a rate change today might not actually hit the economy for months or even years, and that makes this game incredibly hard to play. All right, so let's dive into scenario one, a world where the central banks are slamming on the economic brakes. Interest rates are going up, which means money itself is getting more expensive. And right away, this creates a very clear and distinct set of winners and, of course, losers. And boom, right away, you can see the battle lines are drawn. In the winner's corner, you've got banks and savers who are suddenly getting much better returns. But over in the losers column, well, that's where you find companies with a lot of debt and big chunks of the property market. They're feeling a serious squeeze. Let's dig into the why behind a couple of these. The clearest winners almost always are the banks. Think of it like this. A bank's business is just buying and selling money. When rates go up, the price they can sell money for, on loans, goes up a lot faster than the price they pay for it on your savings account. That gap between what they earn and what they pay out is their net interest margin, or NIM. And as that spread gets wider, bank profits just explode. Okay, now let's flip to the other side of the coin and look at a major loser, commercial real estate. Just imagine you own an office building and you took out a huge loan 5 years ago when money was basically free. Well, now that loan is due, and you have to get a new one at today's sky-high rates. This is what everyone is calling the maturity wall. It is a brutal double whammy because not only do your debt payments go through the roof, but the high rates also push the value of your building way down. But here's a victim that might really surprise you: innovation itself. Higher interest rates are basically a tax on the future. Think about it. A really bold long-term project, like curing a disease or developing a new energy source, is valued based on profits that are years, maybe decades away. When rates are high, those future profits are worth a whole lot less in today's money. This innovation tax is a huge deal. It can cause venture capital funding to drop by 25%, and it slows down the very technologies that we need to solve our biggest problems. Now, let's flip the script completely. What happens when the central bank opens up the floodgates and starts slashing rates? Suddenly, capital's cheap, it's everywhere, and a whole new group of players gets to take center stage. And just like that, the world is turned upside down. The financial gravity has gotten weaker, allowing a whole new set of assets to just take off. Borrowers have a field day, and growth stocks, well, they thrive. But at the same time, the folks who were winning before, like savers with cash in the bank, are suddenly falling behind. It's a massive shift of financial energy. And this brings us to the absolute biggest winner, growth stocks. Now, the reason gets a little technical. It's something called a discount rate, but the idea is simple. Look, if I offered you $100 today, or $100 10 years from now, you take it today, right? Of course. Money in the future is always worth less. A lower interest rate means that future money is worth more today. For a tech company whose biggest paydays are way off in the future, this is like strapping a rocket to their stock valuation. On the flip side, trying to be responsible and just holding cash suddenly becomes a losing strategy. The interest you earn on your savings account basically vanishes. It's almost like the financial system is punishing you for playing it safe, pushing you and your money into riskier things like stocks and bonds just so you can keep up with inflation. Okay, so we've laid out the basic rules of the game. Rising rates are good for banks, bad for real estate. Falling rates are amazing for tech stocks but tough on savers. Seems pretty straightforward. But this This is where things get really interesting, because there is one giant exception to these rules that changes everything. And that leads us to a really crucial question. If lower rates are like rocket fuel for stock prices, then a rate cut from the central bank must always be good news for the stock market, right? It's a green light to buy? Wrong. And honestly, if you take one thing away from this whole explainer, let it be this. The reason for the rate cut matters infinitely more than the cut itself. Think of it like a doctor. A soft landing cut is like a vitamin shot. It's given to a healthy economy just to keep it strong. That's bullish. But a hard landing cut, that's like an adrenaline shot to the heart of a dying patient. The medicine is there, sure, but it's a giant red flag that the economy is already in deep, deep trouble. And look, the numbers don't lie. History shows us that when that first rate cut is really a panic move because a recession is right around the corner, the stock market's performance over the next year has, on average, been negative. The scary signal about the economy's health completely overwhelms any small benefit you get from cheaper money. Okay, so with all that in mind, the big question is, what do you actually do about it? How do we take all this theory and turn it into a practical playbook that can help you navigate these cycles? Let's talk strategy. A really classic, solid strategy for managing risk is something called a bond ladder. Instead of just throwing all your cash into one 5-year bond, you build a sort of financial staircase. You put a little bit into a 1-year bond, a little into a 2-year, a 3-year, and so on. Then, as each short-term bond, each rung on the ladder, matures, you take that money and reinvest it in a new bond at the top. This just smooths everything out and keeps you from getting stuck with one bad interest rate. Now, if you want to get a little more tactical, it's all about managing something called duration, which is just a bond's sensitivity to rate changes. It's actually pretty intuitive. If you think the central bank is about to start cutting rates, you want to extend your duration. Buy longer-term bonds to get the biggest bang for your buck as their prices go up. And if you think rates are going higher, you do the exact opposite. Shorten up to protect your capital. And you know what? It's the exact same idea with stocks. You can think of it like a football game. When rates are falling and the economy is looking good, you're on offense. You're trying to score big with sectors like technology and small caps that love cheap money. But when rates are rising, you switch to defense. You want to protect your portfolio with stable companies that have strong balance sheets, like financials or utilities. All right, let's wrap this all up. If you're going to remember anything, remember these 3 things. Number 1, interest rates are never neutral. They are actively moving wealth from one group to another. 2, context is everything. You have to ask why the central bank is making a move. Is it a sign of confidence or is it a sign of fear? And number 3, you need a playbook. Have a strategy for your bonds, be deliberate about your stocks, and no matter what, always prioritize high-quality investments. At the end of the day, trying to perfectly guess when the central bank is going to move is a fool's game. The real skill, the real edge, is understanding the economic story that's forcing them to act in the first place. It means looking past the daily headlines and focusing on the underlying data. Are you watching the right signals? Because that is what truly matters.